Good morning. Good morning, ladies and gentlemen, and a very warm welcome to the presentation of this year's annual report. These reports represent our contribution to the significant and important policy debates and analysis of the situation of the global economy. We will organize this session in as follows. There will be 3 presentations. I will start by highlighting 4 observations, perhaps my takeaways of the annual report. They all point to the need to adopt a longer-term perspective, one that allows to better integrate finance in our analysis of the global economy. Then Claudio Borio, the head of MED, Monetary and Economic Department, and Hyun Shin, the economic advisor and head of research, will develop some of these points that are in this annual report. So let me begin with an observation about the abnormal current situation, and in particular on the debate about whether the very low rates or even negative rates are the new normal, what it has been called the new normal. Over the past year, 3 shifts in global markets have altered the balance of economic and financial risks. Oil prices fell by about 50% in dollar terms during the second half of last year. The US dollar appreciated sharply across the board, and perhaps the most unusual development of all, long-term rates declined even further, even slipping into negative territory in some markets. If you look at the first months of this year, the 5 months of this year, on average about $2 trillion of sovereign debt, mostly in Europe, were trading at negative rates. These shifts reflect reassessments of the global economy outlook by market participants, and it is not surprising that market participants are continuously reassessing the situation, because despite all the efforts, conditions in the global economy are still far from normal. The buildup of leverage and financial risk, the dependence of financial markets on central banks, and the persistence of these low rates, all these seem to have become routine. But just because something is routine, it doesn't mean that it is normal. So 7 years after the financial crisis, the policy mix remains unbalanced. We continue to rely too much on monetary stimulus, while progress on the structural reforms has remained insufficient, and policy trade-offs are not getting any easier. True, there may be secular forces that put downward pressure on equilibrium rates, but even so, we argue in the annual report that the current configuration of very low rates is neither inevitable nor does it represent a new equilibrium. Rather, it may well reflect the shortcomings of today's analytical and policy frameworks in dealing with financial booms and busts. And Claudio Borio will elaborate on this point and the implications for the global economy in his presentation in a few minutes. Our conclusion in this first point is that policy normalization should be welcome overall, not for everyone, but overall, lower oil prices provide the global economy with a significant growth dividend, and this tailwind could support a steady normalization of monetary policy. And of course, this had to be done with due regard to country-specific conditions. Normalization may generate some volatility in the short term, but would help to contain risks in the long term. So let me go to my second observation, which is in relation of how financial booms can damage productivity growth. Specifically, it refers to our analysis on how financial booms have contributed to the observed decline in productivity growth, particularly in advanced economies that have experienced financial booms. We have often discussed here at the BIS that the balance sheet recession are different because they are associated with the bust of a financial boom. The negative impact on aggregate demand is obvious, but what about the economy's productive capacity? We have tried to do some research, and we have found that some evidence that financial booms have a tendency to undermine productivity growth. And they do that by shifting, at least one of the mechanisms, by shifting workers and other production factors to sectors with slow growing productivity. contrary to what happened in normal recessions, this labor misallocation has long-lasting negative effect on the path of aggregate productivity after the financial crisis. Now, the economic intuition is as follows. In a normal business cycle, workers displaced during the recession will be rehired when the activity picks up. But in a balance sheet recession, the sectors that were artificially bloated during the financial boom, that grew too much during the financial boom, cannot be expected to return to the boom times levels of activity. So misallocated labor needs to move from these sectors to other parts of the economy, which typically will take much longer and may be constrained by supply-side deficiencies existing in the economy. So the resulting damage to aggregate productivity and hence productivity potential output after the financial crisis can be quite persistent. To be sure, this is only one factor. There are other factors behind the trend decline in productivity growth. But the point we want to make is that past financial booms may have done more than just mask these other factors. They themselves may have also contributed to the decline by misallocating resources. And this is an area where more research and more analysis is needed. Now, is this impact significant? Our figures suggest that it is. Our analysis looks at a set of advanced economies that had experienced credit boom in the run-up to the financial crisis, and we estimate that their productivity growth in the boom period, 2004-2007, was on average cut by about 0.4 percentage points every year, relatively to what it would have been without the boom. And by that we mean that the credit to GDP would have continued the trend of the previous decade. But more strikingly, this effect persists even when the boom turns into bust. Our estimates suggest that for the period 2008-2013, this country's productivity growth was on average reduced by 0.6 percentage points per year, again, in comparison to no boom hypothetical scenario. And in fact, in this later period, after the bust, the estimated loss in productivity gains is about the same size of the actual figure of productivity gains. So the effect is significant. I don't think the important are the figures. The important is that it is significant. Now, the main takeaway from this analysis is that we need to pay more attention to the supply side. Demand management policies cannot substitute for measures that deal with supply-side deficiencies that obstruct demand and undermine growth. Restoring strong and sustainable growth requires a deeper analysis of supply-side constraints, which inevitably is very, very country-specific, and it also requires a determined pursuit of reform, of structural reforms. Now, what about the economies that escaped the financial crisis? And this includes some advanced economies as well as many of emerging markets. They too may find some relevance in this link between financial booms and the declining productivity growth. Many of these economies have been experiencing strong credit booms, and they are reaching a point where the combination of these booms with lower growth is giving rise to some domestic and external vulnerabilities. To be sure, emerging markets are stronger today than they were in the 80s and in the 90s. Macroeconomic frameworks have improved, exchange rate flexibility has increased, financial systems and prudential regulation is better. The development of local markets, there are many factors. Larger foreign exchange reserves have strengthened the line of defense. Yet not all is well. Flexible exchange rates and good macroeconomic performance are very important, but may not fully insulate economies from external shocks. While foreign currency debt has come down in relation to GDP, it is concentrated in the corporate sector, where currency mismatches are more difficult, harder to detect, and may affect investment and employment more directly. Now, the role of central banks will not be easy. Foreign reserves may be difficult to mobilize effectively to counter liquidity shortages in specific sectors or to support the domestic currency or bond market. And the shift from bank finance to capital markets may have altered the market dynamics in ways that we need to understand better. It's not yet well understood, and I will come back to that point later. Now let me turn to my third observation coming from the annual report, which refers to the potential risk associated with the price of leverage being too low for too long, interest rates being low for too long, something that, as you know, we have discussed here at the BIS on many occasions. And let me be clear on that. Our main concern is the persistence of low rates. It is the persistence that gives economic agents the incentive to change behavior, and it is the one that allows time for leverage and risks to build up, perhaps so slowly, so gradually that it may be difficult to detect them. Now today I will not go over all this. I will just to focus on two specific issues. One is how this matters for the core business models in the financial industry, and the other is the implications for liquidity market risk. Now very low interest rates for a protracted period of time can hurt banks' intermediation capacity. They make maturity transformation and long-term lending less profitable, and they can erode the franchise value of retail banking. Now, the good news is that large international banks in general, but particularly large international banks, are now on a stronger footing as their profits have boosted regulatory capital ratios. Common Equity Tier 1 increased by 45% between 2011 and 2014. Perhaps the less good news is that banks have yet to regain full market confidence. If you look, for example, to price-to-book ratios of large banks from advanced economies, they are still hovering around 1%, which is about half the ratio of non-financial firms, if not lower. And these low valuations may reflect uncertainties about the business models, including doubts about the consequences of having to live with this very low and flattened yield curve for a long time. Moreover, there are bank exposures to interest risk and also to credit risk that may have increased, and that require a very active management of risk on the part of these institutions. Now let's move to the impact on insurers, life insurers and pension funds. Given the long-term liability structure of these institutions, the impact is even larger. In face of ballooning liability values and declining yields, insurance companies have explored new, riskier investment strategies. For example, in the investment portfolios of North American and European companies, the share of bonds rated below single A, rose from 20 to 30% between 2007 and 2013, and increasingly they are offloading some of these risks onto their consumers. Still, despite all that, the pressure on their financial strength continues. On the pension funds, financial market conditions combined with demographic changes have put a heavy strain on them. Funding ratios have deteriorated relative to pre-crisis on both sides of the Atlantic. For example, pension funds for large corporations, the typical funding ratio was about 80% at the end of 2014, and pension funds have responded to these shortfalls with more aggressive investment strategies, shedding exposures to traditional risk and loading up on alternative investments. But perhaps this is an indication that the problem in aging societies runs deeper. As the number of people worried about their retirement grows, low returns on savings and the shift of investment risks that I have mentioned into households may increase precautionary savings and weaken consumption. Analogously, funding deficits in corporate pension plans may affect these companies perhaps like a debt overhang, constraining their capacity to make new investments. And these changes in behavior may challenge our traditional thinking of economic relationships in ways that we need to analyze better and that require certainly future research. Now, the other aspect, I mentioned two aspects. The other aspect I would like to highlight is the change in the channels of financial intermediation. Capital Markets and asset managers have gaining prominence. Now they reached $75 trillion at the end of 2013, and the sector is highly concentrated. 20 top asset managers account for 40% of the total assets. And against the background of search for yield, one particular important issue is risk arising from market liquidity. Bouts of market liquidity over the past year have highlighted some of the fragilities of market liquidity. Regulation has aimed to encouraging better pricing and better management of liquidity risks, but stocks of debt had continued to increase and trading volumes have continued to decrease. So it's important to prevent liquidity illusions and strengthen market participant resilience to the liquidity shocks. This would make these shocks becoming really systemic liquidity shocks less likely. I think there are at least two issues that these raise for policymakers. One is to get a better understanding of how exposed asset managers are to liquidity and market risk. In particular, some practices may give rise to leverage-like behavior, even if leverage itself in the form of the traditional funding debt may be still relatively small. The question is whether and to what extent the resulting dynamics can create systemic liquidity issues. The other is to understand exactly what prudential policies, whether micro or macro-prudential policies, can and cannot do in their own. The financial stability implications of low rates for long are too pervasive and affect a broad range of markets and institutions. Now let me go to my fourth and final theme that I would like to highlight, which is the shortcomings of the international monetary and financial system and the potential for spillovers and spillbacks. One aspect of this is the interaction of monetary regimes of different countries. The monetary policy of core countries influence financial conditions elsewhere. This happens directly because key currencies, above all the US dollar, are extensively used internationally. For example, is all the debt in dollars but non-residents in the United States. And it happens indirectly whenever currencies resist an unwelcome appreciation of their exchange rate. And as a result, the result of all this are that policy rates are kept lower globally, lower than what some standard yardsticks would suggest. Moreover, if countries resort to foreign exchange intervention, global bond yields are further compressed. And it's good to remind us that central banks and other public entities now hold around 40% of the stock of government bonds in major reserve currencies, is domestic and foreign central banks. And this has increased the sensitivity of world bonds markets to central bank actions. Now, the other aspect is the interaction of financial regimes. Capital moves freely across currency and borders, and this has generated waves of easy financing in international markets. We have on various occasions discussed the concept of global liquidity, and Hyun-Shin will elaborate on some of these mechanisms and financial interactions and the need to consider further spillovers and feedback loops in his presentation in a few minutes. Of course, flexible rates are an important line of defense, along with strong fundamentals, sound macroeconomic policies, and deep and resilient financial markets. But flexible rates cannot fully insulate countries from the international impact of monetary policies in large economies, nor they can fully protect countries from common global factors that are playing an increasing role in domestic financial conditions. I'm thinking, for example, here of changes in risk aversion in large asset managers. Now, for us, this illustrates the existence of what we call a blind spot in the functioning of the international monetary and financial system. The system is unable to constrain the build-up or the transmission of international financial imbalances. In essence, this element of instability reflects the combination of policies with a narrow domestic focus in a world of free capital flows. And a specific question in this regard is whether we might be underestimating the size of potential spillbacks, in particular in the case of emerging markets. Today, emerging markets produce half of the world's output in purchasing power parity terms. Emerging markets borrowers account for 20% of foreign exposures of banks reporting to the BIS statistics, and for 14% of all outstanding debt securities, and these are significant quantities. So what could be done? A first step for us would be to take financial factors more fully into account into domestic policy framework. Just that should help to reduce potential spillovers at source. But there is a case for going further and seeking to better internalize cross-border spillovers and spillbacks. This step is obviously much more challenging, since we still have to develop analytical frameworks that allows us to do all this, integrate finance into macroeconomics, and also properly measure these spillovers and spillbacks. The third element would be there is certain scope for more international cooperation, obviously not in the sense of formally coordinating policy decisions, that's not the point here, but in the sense of sharing information and reaching common understanding on the externalities of domestic policies and the dynamics of spillovers and spillbacks. In other words, there is a case for exercising enlightened self-interest. That means that it is good to keep your house in order. In fact, it's more than good. It's just probably the first priority. But it is even better to also contribute to keep the neighborhood in order, because this ultimately is good for you and it's good for everyone. Now, beyond that, beyond the enlightened self-interest, there is, of course, the question of whether we will need to develop some global rules of the game that could help to discipline national policies more. But this is, I think, too soon, and perhaps it's not the question for today. That will be for another day. So I will conclude. I would say that we should not accept the unusual low rates as the new normal. If you do that, we run the risk of validating the perception that they are the only way to deal with the current challenges. They could entrench the weakness, made the normalization even more difficult, and perhaps not less important, reduce policymaker room for maneuver in case of new shocks or downturns. Rather, we propose that there is a case for drawing on a different perspective, one that is longer, that is more macro-financial and global, and with this perspective, the cost of the current unbalanced policy mix becomes more evident, and unless the underlying problems are addressed head-on, short-term gain may be purchased at the price of some long-term pain. What is the meaning of that? This means that we need to place more emphasis on reforms that remove impediments to growth, support an efficient reallocation of resources, and restore productivity growth. This would ease significantly the burden on monetary policy and help pave the way towards a necessary steady normalization process. So let me finish one final thought regarding our incomplete knowledge of the dynamics of financial markets and their interaction with the real economy. I think we need to develop this long-term view and policies. We need to further improve significantly, I would say, our analytical tools to understand better the interaction between domestic monetary and financial regimes, to fully appreciate the intended and unintended consequences of domestic policy actions, and eventually and ultimately to improve our policy frameworks. So that would conclude my part, and I would like now to ask Claudio to take the floor. Thank you very much.